Hey Rahman, good morning. How are you?
Good morning. Doing well, thank you. And you?
Yeah, good. Thanks. Yeah, the last one was pretty nice. We went through a bit of an introduction with you and covered a whole bunch of subjects that came up during our talk about your background and basically what got you into the markets generally, how your approach tailored over time, etc. So I thought we'd continue our conversation and dig a bit deeper, subject by subject, that came up, particularly with regards to manual versus algorithmic trading in this section, because we touched upon both last time. So I thought it'd be a good place for us to start and address this sort of interesting debate we have in the industry of particularly in the retail trading sector. To do with manual versus algorithmic trading, and
I was never really successful in manual trading, but
you weren't.
I still have some opinions about it.
So before we start, like since you've opened that can of worms, why don't you go for it? Tell me a bit more about your experience with manual trading and why you found it wasn't you didn't find much success in it.
Well, first, I think I never really did 100% manual trading. Usually, I have, even if I did manual trading, some of the trading strategy was automated. And for example, I think I mentioned last time that I had a strategy where I would like determine the direction fundamentally, but then do the execution automatically. For example, I had the fundamental opinion that the euro was overvalued and versus the US dollar, and then I would enter I would only enter in short trades, but the entry was based on technical indicators. So the trading was all done automatically, but I only decided which direction I wanted to trade.
So when you say trading was done automatically, are you referring to execution? Like, so you would do the research process manually, but you'd automate the execution part?
Yeah, right. For example, I would search for pullbacks on a technical basis, like simple indicators like Bollinger Band or some other indicators which can be used to determine if there's a small pullback. And then I would only enter in the direction which I determined manually.
Okay, that's interesting. So how did you go about separating the sort of discretionary side from the execution side? So how would your workflow, what does your workflow look like in that time when you were doing this semi-automated trading? So you'd start out with your research process. Like let's let everybody hear more about how you would bring the two worlds together so they can hear how your perspective on combining manual research with automated execution. Let's run through the beginning.
Yeah, I mean, in this specific case, I would first write the algorithm and test it on backtests to see that it is basically working.
And when you say algorithm, you're referring to your rules, right? Not necessarily an actual algorithm in a programming language or anything, just the rules.
But this specific algorithm was not profitable if you just use it all the time. But my idea was that if I have a fundamental idea where the price should go in the long term, that I could then filter out some of the lost trades.
Okay.
And I mean, the manual side was not very structured. I follow a lot of people on Twitter, and then I get people who analyze the markets. And also, for some time, I had a subscription to research from trading desks, from investment banks like Morgan Stanley and so on. So I would read their research and then form an own opinion based on that.
Okay, interesting. And then once you formed your opinion and you were like, right, I have a trading idea here, what would you do at that point then to get into executing that trading idea on the markets? I'm particularly interested in the part where you would either manually execute the trade, or what did you do in terms of automating that whole thing so you could keep your research manual, like you say, at the time, but once you've done your research, have something in place that just executed on it, just did the work for you?
Yeah, in this specific case, I had an EA on MT4, and the
EA
input
is an expert advisor and MetaTrader, I imagine. Yes.
Yes.
Okay.
And the input was like it had an input parameter where I could say, for example, euro long, dollar short, and so on.
Mm-hmm.
So I could, I would maybe change the settings every week and check if I still want to go long euro or if I still want to go short pound or something like this. And yeah, so I would regularly check the input settings, and then the EA would do everything automatically and also trade. I think it was like 15 or 16 pairs at the same time.
Oh, right. Okay. So that's a lot of pairs now. That's multi-asset scenario like that. How would you manage that? Like, as somebody discretionary, that would involve a lot of manual work, wouldn't it?
I mean, that was one reason why I separated, why I only have a very small portion which I have to do manually, because then the EA can do all the technical stuff. It can loop through all the instruments and then decide which one should be traded. I think if you really want to trade like many pairs and many assets, you have to at least automate some kind of the trading strategy, because else you will be sitting in front of the desk the whole day and check all the charts. I mean, you can also do this, and some people do it very profitably, but yeah, it wasn't the right way for me to go.
Yeah, because this is an ongoing debate, isn't it? In all circles, that whether completely automating a trading strategy is advisable or not. And primarily this debate comes from the discretionary trading side, with good arguments, of course. Like some people believe that discretionary trading is just more advantageous because you have this human judgment factor, this ability to control outcomes by having a good idea of why the trade was executed. People tend to gauge how the markets are trending, or whatever other criteria there may be. There's this sort of psychological, comfort there of controlling risk more suitably or more appropriately if you're manual trading, and that for automating the part of the strategy that they can automate is in actually performing the analysis and monitoring what they've already executed, as opposed to going in completely automated from research through to execution.
I mean, I think it's both a strength and also a weakness, because I mean, in my case, I wouldn't really have the confidence that my judgment is always correct. And what I always like to have is some kind of like confirmation that what I'm doing is correct. And if you do, for example, fully automated trading, then you can always check the last 20 years of backtest and check if the strategy would have been profitable. Of course, that's never a guarantee that it will be profitable in the future, but at least it's like it gives me confidence in continuing the strategy.
You spoke about rules earlier, that you drafted an algorithm, which I understand as having drafted a set of rules that you then would modify over time, right? As you changed your opinion or you saw a different trend. Essentially, you're sort of backtesting in real time your rules there. So I'm interested to know how you would take, if you're manually executing something, how you would take the element of emotion out of it. Like, how did that affect you? Talk to me a bit more about how you would either decide to engage or not engage in any particular trading idea that you've come up with, and what went through your mind at the time. So I'm sure there will be people here who will relate to that, as well as people who are listening who may be completely automated and not really have approached purely discretionary trading for the same reasons as you've highlighted here, that you wouldn't have the confidence, for example, to create such a large portfolio of assets and then manage them from research through to execution manually.
I mean, in this strategy, I also had I could also just set the direction to 0, which would mean that I don't have a specific direction, and the algo would then not trade the currency if I set the direction to 0. I had a way to, if I'm not sure, I can just say, like, don't trade this currency. it's also a reason why I stopped trading this strategy, because I never was like 100% sure which direction would go. And even if you look at all the research from the trading desks, like, I don't know, maybe 40% are long and 60% are short, and then it's not really clear if it's even goes that way. I also checked all the historic trades from these trading desks. They usually, like Morgan Stanley, they give specific trades which they are taking, and I checked the performance of those trades. It was actually quite good in the last 5 years maybe, but during the time where I was using it, it was mostly random. So I thought, well, maybe they are also not the guys who really know where the price is going. And I mean, eventually I then stopped trading and moved to fully automated trading only.
Interesting. So you're, from what I gather, even in manual trading, as far as you're concerned, unless it makes complete sense to you, unless the logic behind it is sound and the numbers add up, it's a statistically sound scenario, the trading idea, you say that you have, or had, when you were doing manual trading, had the discipline to either execute or not, without really being sort of gut instinct about it, not having emotion in the picture.
Yes.
That's a very personal thing, isn't it? I mean, many people have different affinities or what have you for handling emotion in such scenarios. So you mitigated it just as it's just part of your personality. You had the discipline to evade anything that you felt did not make sense or was not statistically backed, at least, right?
Yeah, I mean, there's never really a clear scenario, but usually you can like try to put a probability to some of the outcomes, like, for example, if they are starting tapering or not, yeah. But because of that, for me, it was just not enough like distinction between one or the other. I mean, one thing why I also stopped it was my strategy was using averaging, so it would enter up to 5 positions in the same direction.
Mm-hmm.
So the possible loss case was much larger than the win case,
Mm-hmm.
and I generally I moved away from anything that used grids or such strategies, because it's also emotionally too difficult to watch your position being in drawdown, like for maybe weeks or even months. So I prefer to be out of the market relatively quickly again.
Yeah, that brings up an interesting point, loss aversion. So do you have any thoughts on how loss aversion affects manual versus algorithmic trading strategies? So I imagine that as a manual trader, if you're convinced, you have loads of conviction in your idea and that you feel it's going to go through to where you think it should, loss aversion would be fairly high in that scenario, wouldn't it? You'd hold on to your position and risk.
And also the personal component, that you feel you're responsible for the loss, and I mean, it's just a personal thing that you feel yourself, you are responsible for the loss, but also for the win. So it's like you can say that you are a failure or a success, and
it's like emotional impact, I suppose it was you're referring to. Yes.
Yes.
Therefore, would you say you were more loss averse when you were trading manually versus in an algorithmic and automated environment where you could set very clear exit rules?
But it also depends on like how long the algorithmic strategy holds position. For example, if I have a night skyper, I'm sleeping during the time, so I couldn't even interfere with the positions. But if I'm using a grid strategy and I'm down, I actually had this twice on pound pairs, where I had a grid strategy which had like 20 positions, and at both times I exited at the worst possible moment. And yeah, it was just, I couldn't imagine the price ever going back again, but exactly at that time it's reversed. So I think it's, I mean, there's often this point of like maximum pain maybe, where many people exit. and that might be a trigger to then for the price to reverse. I mean, on the other hand, you also need to have all the information and also stay informed like all the time. So for me, it was too time consuming, but I can also understand if it's, I mean, if you really like to be involved in the market, then you also want to stay informed, and then you can probably take better informed decisions than just follow the momentum automatically, for example. Yeah, but I think both don't have to exclude each other. You can also like have maybe two automatic strategies and at the same time replace a few manual trades.
And on that note, you mentioned earlier on that you were trading a fairly large portfolio. Anything more than like an asset or two in a manual environment, I would consider a large portfolio to handle physically. How did you go about managing that whole activity? Like you mentioned, how many currency pairs was it that your portfolio had when you were trading manually?
15 or 16 or
15
17,
or 16.
I'm not sure 100%.
So that brings a whole new kettle of fish into the picture, right? You in terms of risk. So each currency pair has its own profile. How did you go about managing that? Each asset brings its own risk profile, and standardizing that so that you don't cross your risk tolerance is something that needs to be taken pretty seriously, and hence is fairly difficult or time consuming to handle in a manual trading environment. So how did you go about controlling your target risk when trading a large portfolio of currency pairs as you were manually?
I mean, in this strategy where I had like part of it was manual and part of it was automated, I would only allow to be to have positions in 2 pairs per currency. So I wouldn't allow a third pair to trigger a trade if I'm already filled in 2 pairs with the same currency.
So, for instance, if you take the British pound versus the Japanese yen, the pound yen currency pair, and you compare its volatility to the euro dollar, you've got a fairly different volatility profile. So my question is, I suppose, when you have a portfolio, in your case, of 15 currency pairs, all with varying volatilities, did you have any approach you'd like to share here that allowed you to control the risk, the actual risk of your positions,
I understand.
when considering different, so many different volatility profiles in your portfolio?
Basically, I was using the average daily movement. I mean, you could use the ATR, but it was very similar to an ATR. And then the stop loss and also take profit was dependent on that. So
on the volatility.
Yes.
And consequently, trading a large portfolio of currency pairs, would you say that is primarily what made you gravitate towards algorithmic trading, in that you saw that to be accurate about your research, to be accurate about your entries and exits, it just made more sense to go rule-based than stay totally discretionary?
Yeah, I think it was mostly just the fact that I could backtest the strategy, and it gave me confidence to use it. Even though now I'm actually not anymore so sure that backtests are really a very good prediction of future returns, because you usually have a very high optimization, and the market can also change, and it's not really certain that it will always keep performing the same way. But I still like to have that as at least you can say that it worked in the past, and that's something. So.
Interesting. And then there's the angle of frequency, trading frequency. So again, I haven't delved into discretionary trading as much as some of my colleagues, or you for that matter.
And you can also diversify more through different strategies. Like if you automate things, you can have 20 strategies running at the same time, but you could never do that manually.
I agree completely. It would be quite difficult to manage a large environment, large being diversified, both in terms of the assets being traded in the portfolio, but also from the perspective of strategies, like you mentioned. Diversifying across assets is one thing, but it's also important to diversify across trading strategies, because you have market regime to consider. in that if you want to appropriately diversify in an environment such as we have today with varying volatility across so many different asset classes, it makes sense to not only diversify by asset but also by strategy. Having said that, as you add more complexity of this nature to your work, it becomes a lot of work if you're trading manually, right? So to diversify, if you have 20 strategies, each catering to 16 or 17 assets, so in your case, 15 assets.
I mean, what you could do, for example, if you're looking for specific price patterns, you could have an automatic scan of the pairs, and then you get, like, for example, an indicator which shows which pairs currently fulfill the conditions that you have, but at the same time then only execute if you're manually sure that you want to be long or short in that pair. That could also be a solution.
Mm-hmm. And if you're trading something that's going to last a very short while and is very price dependent, like you've identified through whatever research you've conducted that it's this price that I'd like to get, having a large portfolio of strategies, each having its own portfolio of assets, would make that a pretty difficult exercise to get each price correctly if you're executing all orders manually.
Sure. I mean, I'm just trying to find like counter arguments, because we are both very automatic.
Yeah. No, this is good, because I'm kind of being listener plus devil's advocate in the mix. So it makes for an interesting conversation everybody can relate to. So in summary, manual trading has its advantages. It allows more control over, I suppose, your research. It allows you to modify your trading idea. It gives you the comfort of there's more human judgment in the picture. You're able to control your risk a bit more sort of emotionally and physically. You're able to see the impact or change the outcome of your trade in real time, should you wish to do that. And there are a number of benefits to trading, to having discretionary trading in your life, essentially. The pitfalls of conducting just discretionary trading are that as you scale your effort, as your strategy grows, or as your approach grows, where you have multiple strategies and multiple assets within those multiple strategies being traded, then the workload, time consumption, price sensitivity, if you're trading something that will last a very short period, where positions will last short periods of time and are price sensitive, that's when things start getting extremely difficult if you're maintaining all of that activity in purely discretionary terms. So my question to you is, what was the one factor that essentially told you that, yes, it is time for me to automate a lot of or all of what I am doing, because in order for me to scale this, I need to have automation in the picture? At what point did you arrive at that conclusion, and how have you been about it since? Have you gone completely algorithmic, or is there some part of your process that is still discretionary?
There were a few reasons. I mean, one simple reason for me personally was that I also didn't really have much to trade with at the start. And if you have a few K and trade manually, you need a long time to increase your capital. And therefore, I was also selling expert advisors. And of course, this is only possible if you have like a full automated system, which you can sell.
So you come from a strategy developer background of a strategy developer who was also, you also had a commercial part of your to your side of things, that you were also selling your solution.
Yes.
Okay.
And the other part was just that I didn't really have the time to spend like all the day researching. And for example, during my studies, I also had to study for the exams and so on. So I really wanted to have something that I could just let run and without too much work. But I also realized now that even if you have an automated strategy, you probably will work on it at least 5 years or so. I'm not sure. I mean, every time I find an possible improvement. I test it, and then there are sometimes also bugs which have to be corrected. So it's not like you finish a strategy in 1 month and then you can go on and.
I'm glad you say that. I'm really glad you say that, because our experiences are aligned that way. There's this popular notion, which is that a strategy once in place never needs any further work. It's continuously there are things such as optimization to consider. If you are considering optimizing your trading strategy, there are different market regimes to consider. The phrase past performance is not indicative of future performance is very true, because while your strategy will in theory, based on your back testing, be and have a likelihood of performing the same in future, it will almost never perform the same in future due to a whole host of reasons, as you probably know from your experience, right?
Yeah.
There's like varying market volatility. There are variance in the assets that comes in the future compared to what was observed in the past, technological constraints, price sensitivity, latency. There's many things that come into the picture. So the whole popular the notion that an algorithmic trading strategy once live does not need to be modified is entirely false.
Yeah.
I think more and more people need to hear about it, and we can hopefully do our part in getting that message out there, that both manual and algorithmic trading strategies require continuous maintenance. They don't require, you can't just leave one thing. Well, in discretionary trading, you simply can't leave it at all, because otherwise nothing would execute. But in an algorithmic trading solution, you almost always have to revise your approach, make sure it's still consistent with its forward testing compared to what you observed in back testing. If there are any technological gaps in your workflow that you need to identify, such as a platform upgrade, or if you're trading by API, for example, and changes in an API, or if the assets that you are trading are no longer listed, how does that impact your strategy? Things like that.
I also know a few traders who like re-optimize every a month or two. But personally, I think it's also you shouldn't optimize too much, because while it makes the backtest better, it's not always clear if it really has an impact on live trading. Mm-hmm. But I can also see the case for like re-optimizing maybe once a year, and only using the last 5 years maybe in case something has changed. So yeah, it can also.
And all of those things are variable, right? So your time frame for what you would determine as a time frame, like you just said, 5 years, for example, could be different for different people, and depending on the strategy, right? So somebody might just need to consider the last 2 days worth of data, whereas another person might be better off considering the last 10 years worth of data, or 5 years worth of data in your case. And it's all very strategy specific. So before we go there, I want to sort of take a few steps back, since we've now entered the algorithmic space of our conversation. There is also the notion that programming ability or experience tends to be a factor in whether you can consider automating your strategy or not. And for many traders, this is a real thing, because while people with computer science or generally engineering related backgrounds can find programming a lot more approachable than non-programmer audiences or non-engineering background people, it's a valid point, in that if you've never had exposure to a programming language before, it can be a daunting exercise, and hence limit how much you can scale a discretionary trading strategy. Would you agree with that?
Sure. But I mean, it's also a great opportunity to learn programming and think in the world today. At least to understand the basics of programming, I think it's quite important. So even if you are not that keen, it might be worth looking into it.
Absolutely. I think my stance on programming has always been, it allows you to sort of learn how to be more disciplined yourself as a person, I suppose. it forces you to stick to your guns. When you have a trading idea and you implement it, your algorithm simply won't change based on its mood in the morning or how much coffee it's had. And therein comes the valid argument for definitely considering upgrading your knowledge base if you would like to scale your discretionary trading strategy. Back in the day, programming was not as approachable as it is today. Would you agree? I mean, you had to enroll in courses at university. Books were the only big fat books on trading, on programming, were really the only source of learning a programming language appropriately. But things have matured so much since then. I still remember, I don't remember the name of the book. It was this big fat book on C++ programming that I, for the life of me, can't remember the name of, that I learned my first programming language, threw myself in the deep end and learned C rather than a lot of people who today would just jump into Python, for example.
Sure.
The point I'm trying to get at is that if there is anything preventing someone from, psychologically from preventing someone from approaching programming, I don't think the barriers exist anymore that did in those days when you and I learned programming, because there weren't any interactive courses, there weren't short boot camps, there wasn't the environment for learning programming for fulfilling any objective, trading just being one of them. Like today, people don't just learn programming to trade; they learn programming to make their lives more efficient. There are people who learn how to learn how to program in Python, not because they want to go ahead and write a trading strategy, but maybe they'd like to automate something to do with their daily calendar or something like that. And it's actually much easier to do that today than it was before. So I'd like your thoughts on that. I'd like you to speak to me about how you would have a conversation with somebody today who has a promising discretionary strategy, but who could really benefit from automating parts of it or all of it if they were to simply consider adding a programming language to the mix.
I mean, first, I can also really understand if someone doesn't want to learn programming. Actually, when I ended school, I know I wanted to be a scientist with pen and paper, and I really didn't want to sit in front of the PC all day. And now I'm a programmer, so it's it changed a lot. So I can really understand if someone doesn't want to go the route. I mean, if you have a strategy that is mainly has technical entry conditions, for example, then you could also hire someone to, for example, myself, I also coded for a few people their strategy. And of course, you have to trust the guy that he's not selling it anywhere and stuff like that. But that's also an option.
What advice would you give to people listening right now who would relate to the things we've talked about, that programming can be a daunting exercise? Some may simply not want to be programmers for some reason or the other. Like I have several colleagues, several associates who simply don't have we have very different backgrounds. And when I hear them speak of development in general, I sense this aversion to technology that is a bit misled. It would have been accurate or valid in the 80s or 90s, but I generally think it's misled today because it's so easy for anybody these days to spend 6 hours and learn a new programming language. So what advice would you give somebody who has something really promising that simply cannot be scaled because they don't know some kind of programming language?
I guess I would just try to start somewhere easy and see how it's going. Like if it's most people, if they learn, like if they follow a tutorial, they also have a bit fun and doing new stuff and learning stuff. So it's probably I would just try it out. Personally, I'm not the best example because I actually learned from just looking at the finished products. For example, for MQL, I never followed any tutorial. I bought the source code of an AA which was not profitable. I thought it was, but it wasn't. So, and then I analyzed the source code. So it's a bit, I was always too, I didn't have the patience actually to start small. I always wanted to jump into the finished product. Yeah.
Both discretionary and algorithmic trading strategies are rule-based. In one environment, you're trading manually, whereas in an algorithmic trading environment, you have everything automated. It's the same rules, just you're benefiting from technology rather than having to physically do the work. If you plan on scaling your effort, if you have something very promising that's discretionary at this point, you're going to hit that human limitation at some point, which is that to scale this thing and make it remain valid and be more or less accurate, especially if it's price sensitive, then automation is almost is essential. It's crucial for that sort of environment. The barriers to entry into programming today are practically non-existent compared to years ago, decades ago. I'm referring to. In today's world, we have it's super easy for someone to learn a programming language, such as, for instance, Python. Python is probably the closest thing to English, I would say, that a programming language can get. And I think it has a very fast learning curve, easy learning curve than most other languages. And it also, by approaching programming with the intention of, at some point I'm going to use what I'm learning to scale my discretionary trading strategy, it's a very good place to start. Because if you can figure out how to structure your thoughts in a programming language, you've already crossed maybe 70% of the challenge to do with learning a programming language for algorithmic trading at all. That's the primary challenge, right? How to structure
once you learned it, you can also test strategies more easily. For example, there are like many YouTubers who promote simple technical strategies, and you have no idea if they work or not. They just show you like 5 examples in the history where it worked, and people try it out and lose money. And this way, if you know how to program, you can easily backtest it for the last 20 years and see if it worked or not. So it's, yeah. Absolutely. In the end, it also saves time.
It saves time, yeah. And it allows you to be more calculated in your approach, doesn't it? It allows you to not take an idea at face value, hear about it, and decide that, I heard of this interesting idea, I saw somebody's results, and I'm going to go and use those same rules in my own trading account. It gives you the ability to test that and challenge any ideas that you see that come up. If somebody says, I have this XYZ trading strategy that trades whatever crossover at whatever period, and here are my results, rather than taking the approach of, hey, great, I see somebody else's results based on these rules, I'm just going to implement these rules myself, which is what a lot of discretionary, particularly retail discretionary traders tend to do. Having a programming language in place to whatever level you've learned it allows you to just very quickly test whether that idea makes sense and whether it would work for you or not based on what you've seen. So there's definitely a huge benefit, at least in terms of testing ideas, rather than were you to go ahead and create a full-fledged solution. So as an algorithmic trader, how have you matured over time then? I mean, all of this is like we've been going through a debate of our own right now, and discretionary versus algorithmic, so it's been quite fun. Well, what's happened since you picked up the algorithmic baton and went ahead and started automating most, if not all of your work?
First I would say that it's not 100% automated. Like there's still a very small part that I do manually. For example, for night scalping strategies, I would check if there are important events. For example, during the Brexit period, I would check for debates in the House of Commons, and on those days I would just filter out the pound, so that to reduce the risk. So I still took some manual decisions. I mean, if I have new ideas, I still test them, and I'm always searching for new ways to trade. The first programming language that I learned was Python, but then just because MQL is so important, and yeah, if you want to use the backtester, then it's also easiest to use MQL. Therefore, I then switched to MQL mostly for trading.
And right now, are you doing your research part? Are you doing that in Python or MQL?
Mostly MQL, I would say. I mean, usually I have an idea to improve it, like a small idea, and then I would just check if it's better or not in the backtest. And if it's better, I would include it. If not, I would wait for the next idea. Not too much research at the moment because I'm also focusing on other projects. So I'm not a full-time strategy searcher at the moment. But yeah, if it comes to other things like more complicated data, I would use Python if I want to analyze the data.
And we can cover that in a future podcast as well. Some languages that will permit you to test an idea and just the idea, whereas other languages will permit you to test the idea and possibly create several additional ideas around that original idea. Such as Python, for example, which not only being one of the easiest languages to learn, is also by its design, it enables you to make subtle changes or radical changes to your existing idea and test the results very, very quickly. If you have a trading strategy for MetaTrader, you could always get an insight into how investable your trading strategy is if you were to link your account to Darwinex. You could easily upload your track record or connect meaning just link your existing account so the data gets into the diagnostic toolkit at Darwinex, and you can then have an overall view of how your strategy ranks from an investor's perspective, how stable your risk profile is, et cetera, et cetera, et cetera. So there's huge advantages to uploading your track record to Darwinex if your intention is to scale this and attract more investor capital down the line. So you can actually scale your trading strategy and your trading business as a whole, rather than just trade with your own capital and use leverage, for example. This is again a subject for another podcast where we'll talk about your Darwinian pursuits. But I think that about covers practically all angles that we had today regarding manual versus discretionary trading. In summary, we've addressed the advantages of both. We've talked about how discretionary processes give you more control over both the ideas as well as the elements such as risk. They afford you more emotional control over your environment than one would see from an algorithmic environment. Having said that, the larger your discretionary strategy grows, the more important it becomes for you to automate parts of it, because due to just human constraints, we simply can't, for example, trade a portfolio of 20 strategies with 20 assets. The permutations just go out of control at some point, and we simply don't have as human beings, don't have the ability to manage all of that activity efficiently enough. That builds a case for algorithmic trading. We talked about how programming languages are not as at all actually hard to learn today than they were maybe a few decades ago, particularly these days with certain languages that can allow you to at the very least test ideas really fast, such as Python, that you can learn in a few hours. Really, there are several courses on places like Udemy or tutorials online where you can literally, if you have a knack for reading source code or reading things and making sense of them, you can always download existing source code, of which there is a bundle online, and read through and see how you can structure your trading ideas into this programming language, and then maybe take a course, a short one, on Udemy or places like that to learn the language properly, and then just write your own, or at least test out some ideas that you have or that you've seen, rather than going in blind and copying the ideas and replicating them on your own trading account. And in future, we'll have more detailed discussions on the algorithmic trading side as well, talk about language choices, talk about how they impact your ability to create one strategy or another, choices that enable you to efficiently retest your existing ideas when things change in future, like market regimes or the assets you're trading or any other factor. And we'll cover all of that with you too, because in my experience with you, I know you are into all of that. So I'd
Yeah,
love to
sure,
pick
looking
your
forward.
brains more in future. But thanks. This has been great. Hopefully, our debate sheds light on as neutrally as possible on this manual versus algorithmic trading debate. I know some people have very, very strong opinions about one or the other.
I
Me,
think
for
we
instance.
didn't really make a good case for manual trading. But one thing maybe,
I hope we did.
yeah, I mean, one thing which I might add is that for algorithmic trading, you also need access to the data. So
Yeah.
some data is really hard to get, like, for example, future expectations of growth or other, like anything to do with expectations is really hard to like quantify. So it's easier to judge manually.
Yeah, and on that note, actually, good that you bring it up. The more sources of fundamental information that you're considering, the more important it becomes for you to have a process that allows you to conveniently and accurately take a look at all those sources. So if you're viewing just one source of fundamental data, like analysts' views on XYZ event that would affect the assets in your portfolio, then that's a fairly straightforward task. You just look at that one. But imagine you have a larger portfolio with a larger number of strategies, and they, by definition, have a larger pool of maybe 20 or 30 fundamental sources. Then you, by definition, as a human being, you're simply unable to perform all of that activity efficiently enough without making mistakes, or at the very least driving yourself completely bonkers in doing so. Hence the need for automation, and therein I think lies our good debate, because I don't necessarily think we've made a good case for one or the other, but I think it's been a neutral debate in that we've talked about manual trading and talked about its benefits. And if you're not planning on scaling your effort, there are advantages to remaining manual, actually, rather than going through the work involved in automating the strategy. There's no real reason to go automate something that is perfectly manageable um, without involving additional complexity, right? But if you are going to scale it, if it's going to grow, or if you want to step away from the screen, then automation becomes important. And if you don't have a programming background, that may have been a deterrent back in a few decades ago, when it was much harder to enter into the world of programming without jumping a few academic hoops. But today simply isn't the case. Today you just have entire business models around educating people on programming fast. So I would encourage anybody listening to this who may not have a programming background, but is in this particular predicament of being unable to scale their strategy or their whole discretionary approach because of limitations such as automation. I'd encourage anybody listening to this to at least have a crack at the easiest programming language that there is out there, which I would say probably at this point would be Python. Is there anything easier than Python? I'm not aware.
I started with Python, but I think Python is also the one which will have most value even later. If you're, I mean, it's not only good to start, but also really good. Yeah, you get a good value.
Yeah, you learn how to structure your thoughts in code, and I think that's the most important takeaway with Python. Whether or not Python is right for you is a subject for another day. It's more of a case of, is it right for you given what you're trying to achieve? So I can imagine a lot of MetaTrader specific traders going, well, why should I consider Python when I need to actually implement things in MQL? And the answer to that is, you don't actually need to implement anything in MQL with certain tools that are out there that help you do that. For example, if you have a Python trading strategy that you've built in Python, you can very conveniently use the Darwinex 0MQ or Darwinex Direct Connect packages. Actually, the last one that I just mentioned, we haven't actually released yet, but we have a direct connector now, which we'll be talking about in the future podcast, that allows anybody with a trading strategy written in an external programming language to trade it through a MetaTrader without actually having to do any development work on MetaTrader. And that includes both MetaTrader 4 and 5. So therein lies your answer to that too, that if you're looking to learn something easier than MQL, you can actually do that at Darwinex while still trading inside MetaTrader. So there's that for us to cover next time. Let me make a note of that. I'm going to bug you about that next time. Brilliant.
Sure, great.
But thanks a lot, mate. It's been great. As usual, I think we'll get some interesting feedback to this and take account of it for our next podcast. Thanks so much again for your time.
Okay, see you next time. Yeah.
See you next time. Thank you.